Hello and welcome to another Trades and Tutorials video. This is Jeff Bish, president of MarketGauge.com. And in this video, we are going to take a look at how the leading sectors, or really how most of the sectors, are shaping up in multiple time frames to figure out whether or not this market, which if I take a look right below this sector table that we'll look at shortly, here's a weekly chart of the S&P, and the question right now as we go into December is, will the market break out above this consolidation right around this 40-week or 200-day moving average and blast higher? And one thing we want to take a look at is whether or not the number of sectors are saying that that should happen, or if it does happen, we should follow it, or is it going to head south? And if it does head south, should we be looking for a pullback to buy, or should we really be looking for a dangerous slide? So I got a full video here, but before I get started, I want to make sure that if you're just finding us on YouTube, that you subscribe to our channel. And if you're not already familiar with the fact that this video and many more are hosted on our website, marketgauge.com/tutorials, make sure you check that out because there'll be commentary around this video with additional links. And finally, you can see this video in HD by changing the settings in the lower right-hand corner. All right, so with that, let's go back up to this sector table. So first of all, let me make sure you understand where I'm getting the sector table from. So I've just gone to marketgauge.com and resources, and then little big view, and then sector summary. All right, now the cool part about this is all free, and this is a really great way to keep track of the breadth of the market in terms of sectors, and also find trading opportunities in sectors that are leading the market. Now, I've done a past video on this blog that will describe this particular table in more detail. If I can dig it up, I will perhaps put a link to it, but you don't really need it. If you want to just simply scroll down, you'll see an explanation of the power of this table in helping you determine when you should follow the market when it's moving above or below the 200-day moving average. So the quick summary of it is simply this. The chart down here is giving you a summation of the number of industry groups shown in the table above, which are trading with positive 6-month change. And if it's red, it's the total number of industry groups that are trading with negative 6-month change. Now, if you combine this as an internal strength of the market, along with the 40-week or 200-day moving average, it's essentially the same thing. And in this case, I've got a weekly chart up top so that you can see more data, and that's the blue line here that I'm going over in red. So the idea is if you're above the 200-day moving average and you have at least 4 or 5 industry groups that are positive on a 6-month basis, you've got a strong market. And as you can see, when the market pulls back in an environment where you've got really strong industry groups, it tends to bounce back up. But when the market sells off and you've got really weak industry groups, you get a big decline, or certainly it's a dangerous scenario. So in other words, don't be long under the 200, and certainly be very careful if you're under the 200 and you've got less than 4 or 5 positive industry groups. So that pretty much sets up the scene for right now. It's the end of the year. We've gone back and forth above and below the 200-day moving average. When we go below the 200-day or the 40-week, our industry groups don't hold up. So if we go back down under this level, it is definitely an environment where the market is very vulnerable to a significant decline. So I'd be very careful there. That said, the opposite is true if we break higher and continue to move higher. It would be very easy for this industry group number to continue to move higher. Now, how would you know that? Well, you can follow it right up here in this table. Now, these aren't all the possible sectors, ETFs that you can watch, but it's a good representation of, I think, about 14 of them. And this gets updated every day. In fact, may even be updated intraday. I'm not sure. Some of these tables are updated on a delayed basis. The chart down below is updated on a weekly basis. So intra-week, you can see how many sectors are positive on a 6-month basis. So right now, we've got 4. We really want more than 4, 5, 6. So as the market moves higher, we want to see these numbers climb. Now the other thing you want to take a look at is how positive are they, right? So XLK up only a fraction of a percent. In fact, 3 of the 4 up only a fraction of a percent. So what does that tell you? That tells you that if the market rolls over and starts to get weak, these are all going to be negative, and the number that you're looking to be positive is not going to be positive. So XLY, clearly the leader here. And you'll also notice that we don't just look at the 6-month change, we also give you the perspective of the 3-month change and the year to date. And for this reason, I can see that XLY has done well over all 3 time frames. So this is definitely a leading industry group. And in fact, this is one that I've been trading. Our ETF models have been in for this reason. It's been strong. So here's the primary question for this video. If the market moves higher, which industry groups should we be looking at for potential trades? Now, as I've just said, if the market moves lower, you're going to be able to quickly look at this 6-month change number and see whether or not something strange happens, which is they go up even though the market goes down, and you'd have more of an inclination to look to buy the dip. But under the 200 at this point would really be a dangerous situation based on what we see in the 6-month column. Now, the 3-month column, however, does tell us that we have some interesting developments on industry groups. It's also telling us that with a continuation of some momentum, the 6-month could flip positive. But there's another indicator that I look at, and granted, you don't all have access to this, but you could. And I want to show you, we want to take a look at how these industry groups look in a different measure of market leadership. And this measure is something we refer to as our triple play indicators. And the triple play indicator is not a 6-month percent change, but it does enable us to take a look at a individual stock, or in this case we're going to look at ETFs, and see whether or not that ETF is leading the market in terms of both price and volume. And it's really easy to read, and actually if you want to learn more about this, you can go to marketgauge.com/leaders. We're going to do a webinar on it tomorrow night. So if you miss it, I'm not sure what will happen on the site, but if you go to marketgauge.com/leaders, you can learn more about this. But really quickly, it is very easy to use. This top indicator here is price. The bottom indicator is a measure of volume, and the momentum indicator is in blue, and in both cases, and a kind of a benchmark is in red, and a slower benchmark is in black on the price. And the idea is that if the blue line is headed higher and the red line is headed higher, the momentum is positive in terms of price leadership, but what you want to see is the blue line over the red line, and that suggests that it's not only outperforming the overall market, but it's doing it in a greater and greater momentum. And that's true on the top in terms of price, and true on the bottom in terms of volume. So ideally what you want to see is both of these over the red line heading higher. And then you know that if you get positive price action up top, that's positive price action you want to follow. So for example, in October, XLY, remember this is the strongest one, XLY was consolidating. Its price action leadership was kind of consolidating too, but when the market or the ETF broke out, so did its price line. Its volume line had already been telling you that this thing is in an accumulation type environment. And so when that broke out, it's no surprise that it had a nice run. Now the interesting thing about this when it sold off along with the market is that it got hit harder than the market. However, its volume held up nicely, so it was no surprise that it popped back up. Now I tend to use this in conjunction with your typical moving averages and price and resistance support and resistance. So when it came down to the 50-day and the 200-day moving average here, the volume was still strong and then started to head back up. That was an indication to follow it. More importantly, looking forward, XLY is one I would watch very closely for a breakout to the upside. If the market is going to head higher, this might be one of the first ones to indicate that it's going to do it. And also, this would be one that I'd want to be in. I'm already in for full disclosure. If the market moves higher, it's been leading the market higher, and it should continue to lead the market higher, especially in December. We go into a year-end rally, watch the XLYs closely. So I'm just going to go down the other interesting ETFs here. Let's take a look at XLPs and XLKs. We want to look at all the ones that are positive, and then also want to take a look at some of the ones that are nice and positive on the 3-month, but haven't really gotten to 6-month positive yet, because this is where sometimes you can find industry groups that are emerging as good trades, but they don't have the perhaps 6-month measure that we really like to use as a benchmark. All right, so let me go back to the chart. So I'm going to just pull this off and we'll take a look at the charts on those individual ones. Okay, so the next one on the list, just going down from the top, XLP. Now XLP is only up 0.5% over 6 months, and you can see that that's pretty easy to figure out just by looking at the no travel on this particular chart. But so what we want to look at here, in the last 3 months, it's actually rallied about 3.5%. So that's looking back to down where it was here. So that's pretty healthy. And this is even shorter than 3 months. On a triple play perspective, the thing that would be most interesting would be if we could get the volume to move higher. And if it were to break up over this 50 level and have the volume participate in it, then you got a pretty good condition for it to move higher. So that would be constructive to the overall market. XLK. Now, XLK, compare this to the XLP that we just looked at, and you can see triple play is already in gear here. So this looks good. So the 3-month, if I look back at the table, is up 8.5%. So it's stronger over 3 months as well. It's not any stronger over the 6 months, but that's why we're looking at these different time frames. And what we can see is that this one shapes up really nicely to watch for a breakout. So I know you might not have triple play indicators yet, but if this breaks out in the next week or so, these will still be in gear. This is one you want to watch, just like XLY. All right, let's take a look at the next one, XHB. All right, so this one is, again, interesting in its placement relative to its consolidation, but on a volume basis, it's relatively weak. On a 3-month percent change basis, it's basically flat. On a 6-month percent change basis, it's basically flat. So we'd want to see some really big volume move up and over 37. If I had to pick ones to really like to follow, this certainly isn't one that's leading, but it's shaping up to potentially become a leader. All right, so it's so. All right, now let's just take a look at some of the ones that are slightly negative, like XLF. All right, so XLF, slightly negative on a 6-month percent change basis, but you can see this thing has actually been really healthy on a volume level, right? So this suggests that for this ETF, it's been under some significant accumulation on a price basis. It's been a little rocky, but stronger than a lot of the other ones that we've seen, right? So this is one I would look for. Again, if we break out above this level, and certainly if we get over this 25 level, if you want to look at bigger picture. So XLF over 25, right? You got technology over, what was it, 44, 45, and XLY already in gear if that makes new highs. These are 3 so far that I would keep an eye on for the market to move higher. All right, so in other words, if the market moves higher, look for these to lead, and look for these for trades to be in the leading stuff that could run into the end of the year. IYR, you might not expect this, real estate, but this one coming through that 200, it's got a much different pattern than the other ones. Play basis, and even on a 3-month basis, it's up 4.5% for the 3 months. This could be a trend that continues to move higher, and certainly if we get good volume on the move higher, the volume leadership will kick in as well. It's not the strongest one, but it's certainly a heads up. Keep your eye on IYR. Now I'm going to jump down to one last one that has gotten hammered on a 6-month basis. It's down 6% over 6 months, but in the last 3 months it's up 13%. And this one had caught my eye actually before the 3-month move because of the triple play. So you can see how I would have picked this up. Down here as it was crossing the 50 for really the second time, the triple play was both back in gear, but back in gear really for the second time after this little head fake here. So as a triple play trader, this one was a pretty easy, hey, this is one you want to get in on now, but that's not to say that you've missed it. Right now, still looks really good breaking out over this level, especially if the market holds up. So we've got XLK, that's technology. We've got semiconductors, that's technology. We've got XLY, consumer discretionary, that looks good as well, and XLF looking relatively good if the market continues to head higher, and semiconductors looking higher. Now, what's not on our table, but I know it looks good, is KRE, which is another financial ETF. So whenever I look at XLF, I also look at KRE. And so here's another one that's just in really good shape for this market to move higher. The green line here is a 10-day moving average. You've heard me talk about that in this blog as well. You can use that as a short-term market momentum measure to kind of as a benchmark for stops and re-entries. And if you do that, all these ETFs that I've just mentioned are the ones I would focus on if the market starts to get some mojo on the upside. As I said in the beginning of this video, if the market starts to roll over in any significant way here, however, we're in a very tenuous situation, and all the things that we're looking at here suggest that you want to back away on any significant pullback, certainly if you get under the 200. Hope that helps, and I'll see you in the next video. And if you want to learn more about the triple play indicators, like I said, marketgauge.com/leaders, and I'll also put a link to it on the page that hosts this video.